Whoa, there are a lot of people here today, and I am super excited about that. So if this is your 20th time hanging out with us at this happy hour, welcome. If this is your first time, also welcome. I'm excited to see everybody here. I have a feeling that a lot of people here are here for two reasons. One is real estate investing is a little different now than it used to be. A lot has changed. The market's a little bit different, and I think a lot of us are looking for a pivot. Two, the guest behind me is pretty special. A lot of you have had him in your earbuds while you've been in the car, while you've been driving to work, while you've been at the gym, while you've been doing housework, and now he's here. So get that selfie, I think, at some point. I've already seen him take one, so I know he's cool with it. I think if you've been a real estate investor for the last 10 years, if I was gonna draw an analogy about what it's been like that movie about the amazing sports team that's just crushing it every single day on the field, and then they get cocky, and they start getting a little bit of a big head about their performance, and they start getting a little bit sloppy, and they stop training, and they start drinking on game day, and then all of a sudden, the underdog comes out and sweeps them. And then we have that comeback story, right? They get back to basics and they execute. And this is the time of the market that we're in. It's a back to basics time of executing. And there's been a lot of hype in the market over the last 10 years, a lot of people that have inspirational messages without a lot of detail, without a lot of data behind it. The person behind me, Dave Myers, is not one of those people. I think as we get into a tougher market, going back to the basics of real estate investing and also looking at the data and what's really working, how properties are actually performing, is how we're going to push through this tougher market cycle into the next boom cycle. Now, without further ado, I know no one is here to see me talk, so please welcome Dave Meyer.
Thank you. Thank you all so much for being here. I'm super excited. I talked to a few of you, but maybe you don't know, I actually moved to Seattle a little bit less than a year ago. So I'm really excited to be a part of the real estate investing and house hacking community here in Seattle. And hopefully this will be the first of many times I get to interact with this community here. So as Michael said, the real estate market has really changed, and that's what we're gonna talk about today. You probably all, if you've been doing this for a while, have noticed that real estate investing has changed. It's a lot more expensive, mortgage rates are up, deal flow is kind of tough, cash flow is tough, and everything is very confusing right now. But what I'm going to talk about for the rest of the night is that I actually don't really care about any of that, because a lot of what has happened over the last couple of years, as Michael alluded to, is just to a return to the things that you can do in any sort of market. You don't need to only invest in times of perfect conditions or when things are really obvious or really easy. I'll just tell you a little bit about my own portfolio and how I've done things, because I know a lot of people have said that real estate investing is dead, or it's hard, or it's not working anymore. But I'll be honest, like over the last 2 or 3 years, I haven't noticed much difference. Like my portfolio is doing fine because I never took a lot of risk. I never bought into a lot of hype. I've been doing the same old kind of boring stuff for the last 15 years, and it's worked really well when the market went up, when the market goes down, when it speeds up, when it slows down, because unlike a lot of what I assume maybe some of you do, or a lot that happens in Seattle, this isn't super innovative industry. It's not reinventing something or disrupting anything. It's just really old and boring, but it works. And so I know that doesn't sound like the most exciting thing in the world, but I promise you, it's really reassuring when you see that other people are struggling or can't find deals. And if you just kind of go with the old boring approach, it really works. I'll give you an example. This was the first deal that I bought. It was 15 years ago now. And it was different in 2010 than it is now. But in a lot of ways, there are some similarities because people were very fearful. Were any of you investing in 2010 back then? No one, right? But everyone wishes they invested back in 2010, right? Well, I'll just tell you that if you were there, it was pretty scary because the market was pretty much in a free fall. From 2008 to 2013, prices were consistently going down. I thought it was crazy that my lender asked me for 5% on my mortgage rate. Your vacancies were up. I was working a little bit in commercial real estate at that time. It was a complete bloodbath, and it was scary. But I still went out and bought a deal. I bought something that at that time was maybe a little bit better than break even with current rents. There's a lot of deferred maintenance. It looks okay in that, but it's just a facade. It was a piece of shit inside. And after I bought it, the market just declined for 3 straight years. So on paper, I was losing money every day. All right, we'll just keep talking. But 8 years later, after 8 years, what happened was I sold that property. I bought it for $462. I sold it for $1.15 million. It was 650% equity return, a great cash flow. And it's not because I'm some genius. I had no idea what was going to happen in the market. I didn't know that Denver was going to take off in the way that it did. I just bought according to great, strong fundamentals. I put myself in a position where I could take advantage of these upswings that real estate investing has eventually. None of us, I'm like the data dude. I don't know when that's going to happen again. I'll just tell you that. So the only thing I do is try and position myself to be in the market so that when that happens, I can take advantage of it. And while that's happening, I'm getting tax advantages, I'm getting cash flow, I'm getting amortization. But I'm telling you all this story right now because I think it's really relevant to what's going on in the market today. Because people are fearful, understandably, it is a different market, it's a little bit scary. But I'm just going back to the things I've been doing since 2010, which is trying to put myself in a position to take advantage of the market when it turns around. Right now, we are getting some advantages back into the market, and you can negotiate, you can buy at much better prices. Deal flow is coming back. Cash flow opportunities are coming back. And so if you are a long-term investor, which I think probably most people here are, this is when opportunity comes. Because again, it was scary in 2010 to go out and buy these deals, but that's when you got assets at sale. And in retrospect, everything looks great when you look backwards at that. Now, I'm not saying we're going to get this huge run like we did from 2013 to 2023. I personally don't think that's going to happen again, but we will get that kind of upswing again. And so thinking about how to position yourself into the market is, I think, probably the best approach. So I'm going to tell you just a little bit about my personal philosophy. You may have heard me talk about it on this podcast, so sorry if you've heard this before. But I'm just going to share with you a little bit about how I personally approach real estate in today's day and age. But I'm going to start first by just talking about some of the history that sort of brings us to where we are. Because although I think people, probably because I talk about it all the time, overvalue what's happening in the market, and I think you should really try and think long term, understanding the context of what's happening in the real estate market can help you make better real estate investing decisions. I'll talk a little bit about what I think is coming in the housing market in the next year, and then I'll just tell you the kind of stuff I'm trying to buy. And then I'll leave time for questions. So the history of the real estate market, it's not like the stock market or crypto where things go up and down and it's kind of crazy. It's kind of these big, long periods. I won't go all the way back in time, but you probably are familiar with at least these last couple of years that we've been in. So back in 2000 to 2005, we had this melt up, we had a crash, and we had then this perfect set of time from about 2013 all the way to 2020. If you were to design the perfect time to invest in real estate, like if you asked ChatGPT, what conditions do you need to have the best possible real estate investing conditions, it would describe exactly what happened during here. It would have been wrong because things actually got even better for a couple of years, but that was a very unusual time. Now we've been in sort of this slow come down period and everyone's kind of wondering what happens next. And we're going to talk about that in just a minute, but I just kind of want to dig into these two last periods because they are very much shaping what's happening in the market today and what's probably going to happen for the next few years. So this period, the Goldilocks period, because everything was just right, these are literally all the things you could ask for. Like I said, low interest rates, high affordability, things that people don't recognize, like incredibly strong demographic demand from millennials reaching their peak home buying age. You had amazing rent growth. One of the byproducts of the terrible time that was the great financial crisis is a lot of builders went out of business. So we didn't build anything. There was no supply, so there was a lot of supply constraints. That pushes up prices. And so everything went really well. But obviously that can't last forever, right? You see that you can't have run up in prices without reaching a bubble. And so rather than a bubble popping, which we have not seen, and I will tell you I don't think is going to happen, we've come to this period of relative flatness that I call the come down. It's like you partied a little bit too hard, everyone's a little hungover now, and it's a little bit slow. But I'm showing you this slide because I want you to see that not everything is bad. If we had 7 perfect conditions during this Goldilocks period, 3 of them went away. 3 important ones: affordability, home prices, interest rates, those matter. But there are still a lot of things that are fueling the housing market in positive ways, like wage growth and demographics, rent growth, supply constraints. Those all still exist. And so I'm trying to show you that even though we went to this time that was incredible, we are not in a bad market right now. We are going into a more normal and a more balanced market. And although sort of the change feels really dramatic because we went from perfect to normal, and that feels really hard, we are not in necessarily a bad market. It's a slow market for sure, but it's not like everything is falling apart around us. And I just want everyone to sort of make sure that they understand that. Now, I get that a lot of people, when you see this dramatic shift from perfect to normal, start questioning whether or not real estate investing is worth it in this climate. And that's a good question. I am super biased, so take this with a grain of salt, but I do every year, probably more than that, every couple of months, think about how I want to allocate my own portfolio. I also invest in the stock market. I do lending. I do a bunch of other stuff. And I think it's worthwhile for people to ask this question: is real estate investing still worth it despite some of the increased challenges that we're facing today? And I'm going to tell you what I believe, but I want to sort of frame this conversation because I think the most people, well, I'll ask you, how many of you are here or are interested in real estate investing, at least in part because you want financial independence or want to pursue that in some way? Great. All right. Good. Because I actually think the need for financial independence is starting to go up. And so that is sort of the basis for my argument, and why I still think real estate investing is so worth it is because financial freedom is so important to everyone here. And it is going to become, in my opinion, a little bit harder for people to attain. And I'll just give you a couple of points on why. I think most people understand this either through data and studying economics, or you just feel it emotionally, that our economy is not providing the level of stability that most people want. Social Security is meant to be insolvent in less than 10 years. Job security is down. Pensions basically don't exist anymore. The traditional ways of having long-term financial security in the United States have mostly evaporated over the last couple of years. I'm not going to get into why. That's a whole other conversation that is extremely complex. But I think in framing this conversation about is real estate investing still worth it, I think you need to ask yourself, if you are interested in financial independence, and I hope you are, is there something better? Is there a different way, a different avenue that you can pursue that's better than real estate investing? That's the question I constantly ask myself, because financial freedom is why I'm in this. And so even though things have changed, I think we need to ask ourselves, is real estate still the best way to pursue financial freedom? My first argument for that is pretty straightforward and silly, but I was just asked, like, what else would you do? Like, realistically, ask yourself, what else? If you're not going to use real estate to pursue financial independence, what are you going to do? I mean, cryptocurrency it's made a lot of people extremely wealthy. But the key tenet of financial independence is income replacement, right? You need to be able to actually earn cash on a regular basis to achieve financial freedom. And although crypto has made a lot of people wealthy, it doesn't produce cash flow and it's extremely volatile. So I don't know anyone who would sleep very well relying entirely on crypto for their bills every month. Bonds offer 3-4% now. It's already gone down since I wrote this. But those are really stores of wealth. You buy bonds to stay wealthy. You don't buy bonds to get wealthy, unless you're like actively trading them, which I doubt anyone does here. Dividend stocks, you can make a couple bucks here and there. But realistically, there is no other asset class that offers the same income replacement as real estate, even in today's day and age. Because even though cash flow is harder right now, the day that you purchase it, you still can, maybe not in Seattle, get cash flow within the first year if you're going to do value add, if you're going to put in some sweat equity. But the great thing about real estate is that over time, your cash flow grows and your cash on cash return grows. And so if you were thinking about retiring in 10 or 15 or 20 years, your cash on cash return can and should be above 10 or 20%. Now, the only other asset class I realistically think can do this is private businesses. I don't know if you guys follow people like Cody Sanchez. That's absolutely a way to do it. Personally, I think they're just riskier and more time intensive, but that's a totally viable way to do it as well. But I think you're kind of just replacing one job with another. It might be more lucrative, but that's just kind of how I see it. The second thing is, even though real estate investing has gotten harder, cash flow is less, I had set out to just kind of figure out and quantify how much worse it is. How much has everything changed? And I spent a lot of time doing this, and I built a whole financial model. And what I figured out is that for the average American, regardless of income, the math is very, very similar. If you put 8 to 12 years into real estate, buying regular, on-market MLS deals, stabilized, don't even need to do a very large rehab, it will take you 8 to 12 years to fully replace your income. And so when people ask me if real estate investing is still worth it, I can't think of anything that is more worth it than that. Even though real estate is not perfect, you could still replace your income in 8 to 12 years. I don't really think anything else out there exists like that. I'm talking about cutting 35 years off of your career by just going into real estate and doing this diligently. And that's buying boring deals. If you want to accelerate that time frame by doing more sweat equity or buying off-market deals or hustling a little bit more, you can absolutely accelerate that. Now, that is a little bit slower than it was from 2015 to 2023, but not that much. The math was kind of like 6 to 10 years back then. Now it's 8 to 12. And so although the deals seem dramatically different, the reality is they're only different in the first couple of years. And that is a change. That does mean that you need to have sort of a long-term mindset. But if you're in it for the long term, the deals will even out and you still are going to get the 80% of the benefit that you were getting in the sort of Goldilocks period, even today, even though it doesn't seem as obvious. And I think, just to be perfectly candid, I think a big part of the problem is, as Michael said, there was a lot of hype about real estate over the last couple of years. There were a lot of very vocal people talking about how they retired in 2 years or 3 years and 5 years. And I know a lot of those people, and most of them are still working. It's true. Can you name a single real estate influencer who doesn't have a job or selling something? They're all still working. So I think they are exaggerating a little bit. And I think you need to remember that this 8 to 12 years, even if you're saying that it's faster, this is the reality. That's how the math works out, unless you're starting with millions of dollars. So I encourage people to not get discouraged by social media or the change, and actually just do this yourself. On BiggerPockets, you can download, I made a calculator. You can put your own income, how much money you're starting with, what your savings rate is, and it will calculate how long for you to fully replace your income, even buying on-market deals. You can go check that out for free for yourself. So if you don't want to invest in real estate, that's fine, but don't get discouraged because of what you hear some of these people say. All right, so that's my first argument, the income replacement. The other part that I just want to talk about why real estate is, you probably all know this, a lot of people talk about this, but the return diversity in real estate really makes it a stable asset. And even though we have sort of gone from this perfect period where we had all 5 of these were very strong, right? We had great cash flow, market appreciation, you could do value add, the last 2 kind of always are there, that we are still in a time where 3 out of the 5 are still really good and 2 are just like, okay. And that still, to me, when I look at deals, when I look at like an average on-market deal, even in these conditions, I get an annualized return, not trying that hard, 12, 15%. That's not doing value add, that's kind of on-market regular deal. The S&P 500 averages, if you reinvest your dividends, about 9%. And so even in this lower time period, you're still outperforming the stock market significantly. And if the difference between 9 and 15% doesn't sound like a lot, go look at a compound interest calculator. It is the difference in, could be tens of millions of dollars over the life of your investment. So another reason real estate makes sense. I'll go quickly through these last three, but I just want to mention that real estate, if you grew up anytime around, you all are probably younger than me, but if you grew up anytime during the financial crisis, you probably think that the housing market regularly crashes. It doesn't. It has happened exactly one time since the Great Recession, and that was because a lot of complicated things happened that aren't happening right now. I'm not saying it can never happen again. I would never say that that's impossible, but it is unlikely. And real estate is a much more stable asset class than I think a lot of people give it credit for. If you just look at these prices here, you can see this is clearly the longest decline in home prices. Even this period right here in home prices, did everyone remember? Did anyone think housing prices were going down in 2019? No one even noticed, right? So as you can see, this is the only real significant time of distress in the housing market. It's also a great inflation hedge. If you listen to the podcast, you know I have a lot of fear about long-term inflation, not necessarily in the next couple of years. We have a lot of debt in the United States that can be put upward pressure on inflation, and real estate has proven to be a very good inflation hedge, so I like that. And the last thing that I think more people should talk about is you get to provide to your community. And I know there is this like narrative in the world that all landlords are evil, but I know a lot of landlords and none of them are evil. And so I like to think that having local, regular people own real estate and provide housing to a community is a benefit and something that we should all take a lot of pride in. So now that hopefully you all agree, I'll just go back. That's my case for real estate investing. It's why I still invest in it. I invest in other stuff too, but I'd say 2/3 of my net worth is in real estate because of all the things I just mentioned. So now that we are sort of talked about the Goldilocks era, we talked a little bit about this come down. I've been talking on the podcast for about a year, and I think it's proven mostly right that we're entering sort of this new era of real estate investing that I call the upside era. And although I don't think we are going back to this magical time, and I would never count on that, I'm not trying to say that we're going to get COVID-like conditions where everyone's going to get rich overnight. That is not going to happen. But I think we're entering an era of opportunity for real estate investors who are going to not care as much about the hype, who are going to care more about the data, who have long-term perspectives. And there are still a lot of great things happening in the housing market. We're going to have a lot of demographic tailwinds and demand. Probably the most important thing about the housing market that most people don't talk about. People like to say in the media that no one's going to buy a house because of this or that. People buy houses at a certain age. That's just how it works, as soon as they can afford it. The problem in the housing market right now is affordability, but long-term demand is there, and it's going to stabilize the housing market for a long time to come. The upside era that we're in, I think the challenge it's going to have is it's not as obvious. It's not going to be, you're not going to see people going on social media and talking about how they made 200 grand in a flip in like 3 months. It's going to be a longer term approach for people who are just a little bit more disciplined, who want to be more precise about their investments, who honestly just want to use the tactics that real estate investors have used for literally centuries. People have been doing this. This is the oldest business in the world. People have been doing this forever. And the tactics that worked then still will work now. But we're going to see a lot of people, the get-rich-quick crowd is probably going to move on. And so you're going to hear a lot of people say that real estate investing is dead. You're going to have some people pushing riskier and riskier strategies to try and chase those returns that are not coming back. But for the people who just want to take that slow and steady path, that path is wide open right now. So I want to just talk a little bit about the market and where I think things are heading. So we are entering a buyer's market. I don't know how into this market you are here in Seattle, but this basically means we're going from a period, a seller's market, where there were more buyers than sellers. So people are competing for those limited homes. That pushes up prices. We're swinging back in the other direction. There are now more sellers than buyers in most markets. Seattle's pretty even, but on a national level, we're swinging back in that direction. And that is actually, I think, a good buying opportunity. And so we'll talk about that more in a minute. But I kind of want to just talk about a couple of different things as into that. So a lot of people look at a shift towards a buyer's market and say, there are no buyers. You probably see this in the media a lot. People say buyers are leaving, they're evaporating. That's actually not true. There's actually more buyers in the housing market today than there were a year ago. And that has been consistent all year. And the reason that we are seeing this go into a buyer's market is there's just more inventory. That just means more people are listing their properties for sale. And I'm bringing this up because I want to explain that I get this question every day if the housing market is going to crash. If the market is going to crash, you need to see both things happen. You need inventory to skyrocket and you need demand to plummet. We are seeing inventory modestly go up and we are seeing demand actually modestly go up. And so even though things are very slow right now and transaction volume is very low, there is not currently any data that suggests we're entering a crash. And I'll talk about that a little bit more. I'll skip over this, but you could just see there's a lot of regional variance. That's normal for the housing market. In Seattle here, we're pretty flat. And affordability, as I talked about, is pretty bad. But let's talk a little bit more about affordability, because my whole thesis for many years has and will continue to be about affordability, and that the housing market will go as affordability goes. Now, Seattle's in a little bit of a bubble. It's very expensive here, but incomes are also very high here. So it's a little bit different here. But I still think the principles remain, is that if you want to understand where the housing market is going, we need to predict where affordability goes. Because as I said, demand, demographics, actually quite strong. The only thing that's holding back demand is affordability. People think in economics, when you say the word demand, that you mean just how many people desire to buy something. It's actually not what it means. It's both the desire and the ability to buy something. And so the desire is absolutely still there, but the ability to buy for the average American is not there. We actually have the lowest affordability in the United States that we've had in more than 40 years. And so if you want to predict where the housing market is going, if you want it to get better, affordability needs to get better. If you think it's going to get worse, affordability needs to get worse. That's sort of how I think about the market. And affordability is not one thing. It's made of these three variables. So it's home prices, obviously, household income, so if wages are going up or down, and mortgage rates. And I'll just explain to you where this might go, because that's kind of what we all need to understand. It's like where these three things are going to go is going to tell us if the market's going to go up or down. And if we know about what the market's doing, or if we have a good idea of what the market's doing, we can base our own investing decisions around that. Now, I don't know for certain what is going to happen. I told you that at the beginning, and that's just true. So I'm going to just explain to you three potential scenarios that might play out over the next year, and then I'll tell you which one I think might happen. So we talked a little bit about the crash. I won't go too much into this because I already gave it away. But if you think that a crash is absolutely still possible, like if you sit here and try and game this out, like how does this happen? Well, we do have a very sort of concerning economic thing going on in the United States right now. We are seeing the labor market slowly deteriorate. It's not terrible, but it is getting a little bit worse. We're also seeing inflation getting a little bit worse. That's a situation called stagflation. Now, we are not in like a full stagflationary period, so I wouldn't freak out about that. But if those trends do continue, we could get in a really bad situation, because stagflation means interest rates are going to stay high because inflation is high, right? At the same time, the labor market gets worse, so people are going to be in financial stress. If those two things combine, and over a long period of time, in any serious degree, we could get a crash some point in the future. The good thing about market crashes, there's not a lot of good things about it, but the good thing about it is they're actually relatively predictable if you know where to look. Now, everyone from 2005 to 2008 just decided not to look, but it was all there in the data. if the market is going to crash, again, remember, we need demand to go down, we need supply to go up. The only way supply really goes up is if people are forced to sell their homes. Right now, there's supply, inventory growth is actually slowing down because people are saying, yeah, not a great time to sell your house, I'm not going to do that. But if all of a sudden people no longer have that choice and they're financially burdened and have to sell because they're going to get foreclosed on or they can't make their mortgage payments, that's a condition where you get a crash. But you would see that because there's tons of really good data about delinquency rates in the United States. It's extremely low. It's lower than it was pre-pandemic levels. It's gone up a tiny, tiny bit, but as you can see, it's really not bad. And as you can see here, the average credit score for people in the housing market, very good. People are basically paying their mortgages, and that makes this crash scenario pretty unlikely. The second scenario that can happen is something called a melt up. I think a lot of people are talking about this right now. They're saying, President Trump is going to get Jerome Powell to lower the federal funds rate. That's going to push down mortgage rates really significantly. Everyone's going to jump back into the housing market, and then all of a sudden prices are going to go back up and they're going to take off like they did during COVID. That is possible. That is something that is within the realm of reason, but I think the only way that realistically happens is if they institute something called quantitative easing. I won't get super into this, it's very nerdy, but basically the Fed lowering the federal funds rate doesn't really lower mortgage rates, but they do have a tool where they can go out and buy mortgage-backed securities. That pushes down mortgage rates. If that happens, I do think we will see prices start to go up, but it will not, in my opinion, be the full-on melt-up we saw during COVID, because it will bring demand back to the market, but it will also bring supply back to the market as well. So another possibility, though. The third option is the one I think is going to happen. It's what I call the great stall. But it's basically where those affordability, the three pillars of affordability that I talked about, housing prices, mortgage rates, and household income, all gradually get better. So you get mortgage rates coming down a little bit. You get home prices coming down a little, and you get incomes continuing to go up. And that's actually a way that you can get affordability back to the market, which I think is so important, without anything super dramatic happening. You don't need to see this really huge crash in prices, or you don't need the Fed to manipulate the market to push down mortgage rates to 5 or 4 or something like that. What you need is time. It really just is going to take time for the market to get back to a normal, healthy level. And the encouraging thing is this has actually already started. You probably haven't noticed it because it's mild, but for the last 5 months in a row now, affordability has improved in the housing market. Real house prices have gone negative and have been somewhat negative for the last 3 years. No one's cheering about 6.25% mortgage rates, but it's down from 7.25% starting in January. And real wages are still going up. And so this, to me, is the most likely scenario for the housing market, is we get these modest improvements in each of the three pillars of affordability, and over time that gets us back to a healthy housing market. Now, I understand that that might not sound like the most exciting thing out here, but I actually think it is probably the best possible outcome, because ultimately we're in an unhealthy housing market, and you can't really get from where we are today back to normal without some level of pain or just discomfort in the market. And so I think the great stall is actually probably the best scenario. I think it's better than a melt-up. I think it's better than a crash. I just kind of skipped over it, but there's a fourth option, which is like a black swan event, something none of us can predict. But I want to always say that that's up there as well. So these are how I see things happening, depending on the day in the news cycle. Black swan, I'm like somewhere between 55 and 95%, depending on how nervous I am that day. But it feels like a little black swan-y, just everything going on right now. Geopolitically, it's a lot. So I'm joking, but I do think there is something we could not see happen. But I think realistically, the great stall is the most likely scenario. If we do see quantitative easing, I think that melt-up is possible. I still think that crash is pretty unlikely, but since the economy is so uncertain, I think we should have to at least account for that probability. Now, I'm sure if any of you are analysts, you're like, this is just complete garbage. Like, you're just telling me that anything could happen. But I actually do think that this is really useful. And I have personally constructed my own investing philosophy and plan around this. So what I recommend people do based on this reality is there's 4 parts to it. The first is to plan for the great stall. The second is to have appropriate expectations, particularly short-term expectations. The third is to protect against downside, and the fourth is position yourself for upside. Now, I think that the great stall sounds boring. There's great opportunities in there. You have to take what the market is giving you. And what the market is giving us in the great stall is better inventory and better negotiating time. Time on market now up to 63 days. We're going from a time where you had to beg to get into a showing and you had to offer and waive all your contingencies to a time where you can easily negotiate, where there are going to be a lot of motivated sellers, where you can name and be picky and be very, very patient about price and terms on anything that you buy. And so that's the first thing that I really recommend people do, is not see this market as your enemy, but figure out the benefits that it gives you. There is no perfect real estate market. Even during COVID, I was joking that it's, Goldilocks and it was perfect. It was hard to find deals. It was super competitive, right? Those are trade-offs. Pendulum swings back the other way. The trade-offs are that there's better deal flow. I actually think cash flow prospects are going to get better because home prices are probably going to dip and rents are relatively sticky. That improves the opportunities for cash flow. And so plan for those kind of things and start to look for those things. The second thing is having appropriate short-term expectations. I think a lot of people are going to miss out on what happens in the next couple of years in the real estate market because they're looking for home runs. I personally never look for home runs. I try to hit doubles. Sorry for the sports analogy, but that's how I think about it, is just trying to get solid deals. And I'll explain a little bit more of that in a minute. But I think expecting to get rich, expecting to do the perfect BRRRR, expecting that you're going to get 1% rule deals, rules of thumb that were invented during this magical time in the real estate market that is not coming back. So if you hold yourself accountable to rules from a different era, you're going to be very disappointed. You're going to pass over every deal. And I do think you do need to be very patient in this market, but I think if you sort of have these appropriate long-term expectations, you're going to see that better and better deals exist. Now, the third thing is protecting yourself against downside. And I very specifically, you can't see it anymore, but the fourth one was look for upside. I very specifically put them in that order because I think in today's day and age, it is more important to protect yourself against risk than it is to look for upside. I am a pretty conservative style investor. Again, not trying to hit home runs. I just don't want to get out. I think that's the most important thing. And that's what I talked about that I did in 2010. It was a declining market. I just bought something that had great cash flow, that was going to have high tenant demand, that was going to, I underwrote very, very conservatively. I know a lot of people say, don't play scared, get out there, get in the game. I am the opposite about that right now. I think you should play scared. You should be very skeptical of the deals that you do. But there are still deals. I was looking at them today. I found a couple of deals I'm probably going to write on, but I also rejected 50 of them. And I think this is kind of the approach that everyone needs to think about, is that that's normal, by the way. That is how real estate normally works, is that most deals are not good for real estate investors. So I really recommend, one, underwriting very conservatively. I personally am expecting 0 appreciation for at least the next 2 years and 0 rent growth for the next 2 years. I hope I'm wrong, but if I will underwrite that way in case that, which I think is probably, I don't think that's the most likely scenario, but I'm going to position myself so that if that does happen, it's fine. That's what I was expecting. If I have those appropriate expectations, then I'm just going to be fine, and these deals do exist. The other thing about protecting against downside, unless you're house hacking, I know this is a house hacking group, so if you're just buying a traditional rental property, it really has to cash flow. I know there are a lot of people out there who say you can invest for appreciation. I really never recommend that, but I really recommend against it right now. I don't think we are going into a time where we're going to see a lot of appreciation nationally for the next couple of years. It may happen here and there in certain markets. Seattle might outperform in that. It's a very strong market. But just generally speaking, I think planning for normal appreciation, which is about 3%, makes a lot more sense. Now, of course, I am not trying to be in real estate just to do boring deals. Like, I like to find ways where I can take these doubles that I'm trying to hit and place a bet, right? See if you can make it a home run. And that's how I think about it, is what I call upsides. So if you find a deal that works conservatively, underwriting, you have appropriate long-term expectations, it cash flows, it's got, you're not going to get out. How do you try and steal a base? To continue this terrible baseball analogy I'm on right now. How do you try and steal a base? Well, I think in each of your deals, you want to look for what I call at least 2 to 3 of these upsides. 2 or 3 things that give you the potential go from an okay deal to a great deal. And this is what I mean sort of about positioning yourself into the market, because you don't know when rent growth might take off. But if you have a property that's in an area of great tenant demand, that's an upside, right? That's something that might turn out for you. Or if you buy in the path of progress, I'm not counting on appreciation, but if you buy in the right area, you're giving yourself a chance when the market shifts to sort of ride that wave upward. And so those are just 2 examples of the upsides. The other ones I think are rent growth, which I think might be on our side as investors in the next couple of years. We're working our way through this huge multifamily glut. The pendulum has really swung back in the other direction on that. And so I do think maybe not in the next 6 to 12 months, but in the next couple of years, we will see rent growth again. Value add, just buying a property, fixing it up, works in almost any market. And this is actually one of the things that the great stall might give us as well, because an interesting thing happens when you're in a sort of buyer's market like this. Properties that need a lot of work, that have not been renovated in a long time, the prices go down faster than stabilized assets. And so that actually increases your potential margin when you're doing value add. Now, I'm not recommending everyone go out and flip, because the selling part of it is still risky. But if you want to do something like a BRRRR, that kind of takes advantage of the best of both worlds right now, right? Because you're taking advantage of the lower asset prices, and then you're positioning yourself to get growth into the future, and then you have the optionality to sell when it's a better time to sell. We have buying deep. This is buying below asking price. I'm telling you, I've noticed it here in Seattle. This is possible now. Of course, everyone says they want to buy below asking price. I think you need to go one step further than that, because anyone can ask for anything. What you need to do is buy below current comps. That's the really important thing. Figure out what you think an asset is worth and try and buy 2, 3, 4% below that, because that protects you. Again, that's another way, one, to protect you against downside risk, but also when the market turns around, if you bought it at 4% under, you're going to get instant equity growth into that as well. Not everyone's going to be willing to negotiate, but more and more people are. Zoning, someone over here is an ADU person, knows all about this, but this is a great opportunity. Adding capacity is a great upside, even for a regular rental property. I think one of the great options too, especially if you're just getting started, you don't need to do it right away. You can buy a property that is zoned for ADUs, save up some money, develop it later. So another way to, again, take a good deal and make it great. Owner occupied, always think this makes sense. House hacking and live and flips, great way, tax advantage ways to make money. Path of progress we talked about a little bit. And then I also just want to call out learning. I think it's really important to find opportunities to learn new skills. I'm flipping my first house here in Seattle to learn. It's going okay. I think it's going on the market next week, so we'll see. I'll let you guys know. But I'm learning a lot, and I think this is another really important upside. Like if you can do just an okay, solid deal, I'm not saying buy bad deals, but like if you can do a solid deal and it's going to teach you a lot, to me that's already a home run. Like that's something that's going to help you over your investing career. So those are some of the upsides. I'm sure there are others. I just want to call out before we stop, and I'll go into questions. What is not an upside is waiting for mortgage rates to come down, or for cap rates to expand, or for anything like that. What I'm talking about with upsides are things that are more in your control, things that you can do the research on, like path to progress. Like that's not fully in your control, but you can do the research. You can understand where infrastructure spending is going, where businesses are investing. You can do that work and have that out and position yourself for that outcome. What I hear people say often is that, they heard that some sports team's moving to town and they're going to move over here. Like that's not an upside, that's speculation. And the same thing goes true with about mortgage rates or cap rates. Do not speculate. That is not what I'm saying. I'm saying like go out and find things that you are good at. If you're good at research, find the path of progress. If you're good at value add, go do that. Look for things that you have some semblance of control over rather than waiting for some magical thing to change, because it might change, but it might not. And so you don't need to speculate. You don't need to guess. You might as well just do the things that are a lot more predictable in real estate. So that's my basic framework. This is what I do. I do kind of boring investing, but this is what I'm doing. Planning for the great stall. I am not expecting amazing returns in my first or second year, but I am focusing on buying deals that I will be happy and proud to own 5, 10, 15 years from now. I'm trying to get them at great prices. I'm trying to stabilize them as quickly as possible and have at least 2 or 3 upsides per deal. So far, I've been traveling a lot. I started like in the last week or so looking at deals again, because this is kind of when I buy deals because I'm less busy for work. And there's tons of opportunity, honestly. I don't buy rental properties here, so I'm not as familiar. But in the Midwest and in Denver, there's way more opportunities. And so I'm quite encouraged by that. And so not everyone, this might not make sense for everyone, but it's what I'm doing. And I think for a lot of investors, it's a playbook or framework that can work. So I have a little bit of a contradictory opinion about real estate markets. I think a lot of people in the industry look at the South and the Southeast and invest there because there are interesting things going on there. Personally, my whole world of real estate is about affordability. So I invest in markets where the average person can afford the average home. I really think that's important because it means there's going to be lifetime demand for that, right? There's always going to be someone who wants to live in an apartment that they can afford. There's always going to be demand for homes that families can live in. And so for me, it's really about the Midwest is where I personally invest. Again, it's not going to be home run markets. I'm not expecting huge growth in any of these, but I invest in Michigan. I think Wisconsin's really good. Madison, Milwaukee, Grand Rapids, Detroit, Indianapolis, those kinds of markets, Des Moines, Iowa. For me, if you were looking for an 8-12% cash on cash return in the first year or so, and solid, steady growth, all of those markets offer that. Sure. Yeah.
What was your worst deal and what did you learn from it?
I'm pretty fortunate. I haven't had any rental properties I've bought do poorly. I am in one syndication that is on the fritz right now. I actually think of syndications doing better, but my own due diligence, I think what I missed in that was supply risk, which you don't have much of here, which is good in Seattle. But in a lot of these southeastern markets, or west, this is in Texas, it looked great. And then right after I invested in this, all these developers announced projects within a mile of it. And so it's not doing poorly, but the rents aren't growing in the same way. The vacancy is a little bit higher. And I started, when I invest outside of coastal cities, really starting to try and understand construction a little bit better, because that could really throw things off. When you're in a market, for better or worse, a lot of coastal markets make it very difficult to build. And so you don't have that same level of risk. So that's probably the worst one that I have right now. I have ones that are just big headaches though, but they've performed okay. Yeah.
Yeah, you spoke a little bit more about the locations which you invest in. Can you expand on that buy box a little bit more? So the type of class properties, maybe the nuances there. Yeah.
Sure. Yeah. So when I'm looking in just Midwest markets, which it's on my mind because I've been doing that the last couple of weeks, I am looking for usually a C plus B property, but in a good location. In the Midwest, it's a little bit different from here. What you get is a lot of really old housing stock, which is challenging. So I try to avoid that. I try and find things that are 1940s or earlier. When you go into some of these markets, it's 1890s. And some of them have been updated systems, but so I try and avoid those. But I'm looking for something that I can stabilize within 1 year. And if you guys listen to the podcast, I am terrible at naming things, but I call it the slow BRRRR is kind of this thing that I've been trying to do. Which if you're familiar with the BRRRR method, it's buy, I always get this wrong, buy, rehab, rent, refinance, and repeat. Basically, it's kind of like flipping, but you hold on to the property. But one of the things about BRRRR that's challenging is there's this time pressure to do it quickly. what I try and do is find places that are occupied. I don't mind when there's tenants in place. I wait for them to move out and I sort of opportunistically just do the renovations on the properties. But I'm looking mostly for cosmetic rehabs. Paint windows, that kind of stuff. But right now, I'm seeing that I can buy units. The other thing I look for is about $125,000 to $130,000 a unit or less, because then you're getting 1% rule deals right off the market before you renovate, which is pretty amazing. Like, people say that stuff's dead, but you can do it in a lot of markets. But I really like the upside thinking in that is like, I want to be in usually like a B+, A- neighborhood. So I'll do a little bit more work because I just think that long term these kinds of things will appreciate. And that will, then I get cash flow now, hopefully big appreciation kicker at some point.
Gotcha. So it's more multifamily, not single family.
Yeah, usually, yeah. I would do single family, but I prefer small multifamily. Just less units to think about. Yes.
For you right now, what is the best real estate investing strategy that you use, knowing that there are BRRRR, split, 100% owned, or partnership?
Yeah. I really like this like slow BRRRR for a lot of people. I think it just makes a lot of sense. The BRRRR, it just is a good strategy. Like, it kind of combines the best of a lot of worlds. You get the stability of a rental property, you get some of the upside of a flip, but you get the cash flow, you have less time pressure. I think what's causing people to say that the BRRRR is dead is they're expecting to refinance 100% of their equity out, which might happen, but is very unrealistic. And I think people honestly are getting a little greedy when they're talking about that. I think expecting that you can just like do a magic trick and own an asset for $0 every time is just not real. And so I think if you go into it expecting that you're going to leave some percentage of your money in, that's fine. Like, the way I've been thinking about it is like, can I basically refi at least my renovation costs back in? So I'm getting basically an improved value, I'm getting all that improved value, but without really keeping any more than a traditional down payment into it. But that's because I'm paying cash for the renovation. So that's how I think about it. But I do think that if you want just like a really solid deal that's probably going to get you 20% annualized return, which is amazing, like, you could just do those kinds of BRRRRs all the time.
And what do you believe in, 100% ownership or partnership?
I don't think there's a right answer there. I've done both. I started my career doing partnerships out of necessity. And that went fine. But now I primarily buy things. I do both. So I think it just depends on the deal. If you have the capital to buy on your own, it's a little bit easier. But I think when there are deals when you can bring someone in who adds some sort of expertise that you might not have, that's when I would consider doing partnerships again. Like, for example, I sometimes partner with people who have more construction experience because that's kind of like a weak spot of mine. I know enough to be dangerous about it, but I'm not good at it. So like, that's when I would bring, if I wanted to do like a heavy value add, I would partner with someone who could handle that part of it, because it will allow me to access deals that I wouldn't be able to normally. So I just think it's like, if it's just a vanilla sort of property, I'll buy it myself. But yeah, sure. Yes.
So what are your thoughts about investing, especially in Midwest and those areas, in new properties that do cash flow?
I think it's a great idea. I have not done it myself, but I've had like a few people on the podcast recently. It's just a very unique thing. And I don't know if you all know this, but right now the median price for a newly built home in the US is less than an existing home. It's the first time that that's ever happened. And so it's cheaper to buy new homes. On top of that, like, I saw something today that D.R. Horton, one of the biggest builders in the country, is buying people's rates down to 4%. I know Lennar is buying them down to 5%. So you can basically get a brand new asset at a lower interest rate and oftentimes better terms. I think the risk is where builders build sometimes is in the middle of nowhere. So you need to like find stuff that will be competitive. Like, my concern is what I said to the gentleman over there is like, I worry sometimes about these subdivisions that no one's going to want to live there. Or if your neighbor who has the exact same house is in financial stress as you, and they just like, you know what, I'm going to cut rents by 30%. That's your new comp, and you have no other way to compete against them because they're literally all the same home. So I personally think about that stuff. Like I went and looked at some properties in Indianapolis that I was very compelled by because they're urban infill. So they're building duplexes in the city that were cool and like were in a desirable neighborhood. Like that to me is much more interesting. I don't think you'll get as good deals because they're all losing money on the ones in the cornfields. But that's how I would think about it. But I think it's pretty interesting right now, and it's going to continue to be interesting.
Yeah. What are some of your go-to apps or software tools that really make a big impact on your?
That's a great question that I am not equipped to answer. I just have property managers, to be honest, who do most of this stuff. People always ask me, or all of our sponsors at BiggerPockets, they're like, "We use RentReady." I'm like, "I use what my property manager uses. I don't care." So I wish I could answer it better. I'm pretty old school with like data analysis. I do it all myself. Like I download data and look at it for market analysis and that kind of stuff. So I'm probably not the best person to answer that. I wish sorry. not my expertise. Yeah.
I know you're new here to Seattle, but what's your initial impression of investing here, knowing that we're kind of in this weird version of maybe the great stall of home prices are still really expensive, and now the lucrative income of tech work is in question, right?
Yeah.
People are getting laid off. They're afraid they're going to get laid off. So people maybe are hesitant to let go of a home because they don't know if they can get back in, or they can't buy a home even though they thought they could before.
Yeah. My impression is that it's a little bit of a risky time for the Seattle market. Not if you're house. I think house hacking usually works. Run the numbers, but in most cases it works. I think for flipping, which has traditionally been like kind of the way a lot of people make money here, it's just risky right now. Disposition is hard. Everyone I know who flips here, still making money, but like they're a little nervous. So like I think we're kind of just in this weird time, and I would exercise caution. Like I am doing a flip because got a really good deal on it, and I was like, even if this takes me 9 months to sell, like I can still make money on this. So I was okay with that, and that's kind of the underwriting scared thing, I think, is what I would recommend. I don't think there's any opposition to investing in rental properties here. I just invested 2 months ago into a syndication multifamily in downtown Seattle. So like I think rents are going to be good. I just don't know realistically how easy it is to cash flow. So that would be my challenge there. But I think these things always come, and they're awkward and they're tough, but like Seattle's a very good city, has a very strong economic engine. It's a very good market, and so it will work. We might, who knows how long this like flat period will last, but like it will come back. So I think long term always works. Like kind of what I was talking about on the national level, short term is just kind of risky all over the place right now. Any other questions? Yeah.
So I know that you mentioned that you have had a property that has been a headache on you.
Oh yeah, plenty. Yeah.
So I have had like a similar one, like one of my properties that I bought very first time.
Yeah.
Is, it's helped me like both manage my headache and then also a cash flow challenge as well, right? So in that kind of scenario, like what do you think about, right? Do you think about tapping it out?
Yeah.
What are your thoughts?
I think it's a great question. I think one that a lot of people are asking, like if you have a property that's either a management headache or challenging cash flow wise, like should you sell it or what do you do? People think about this differently. I would sell them. For me, I look at almost all of my investing properties in the same way. I think about it on return on equity as like kind of the metric that I guide myself by. And if I look at a property and say, this is earning me a 5% return on equity, I could go reinvest this at a 15% return on equity, I'm just going to go do that. Like, even if I have to pay some upfront fees, like I would prefer to do that unless you're in some like A+ neighborhood and you're like, okay, this is going to turn around and be a home run for me in the long run. I personally think I'm more comfortable like cutting bait than some other folks in real estate. Some people just buy and hold and do it forever, and there's nothing wrong with that. I'm just like a psycho, and like I'm always analyzing every deal over and over again and like trying to optimize every little thing, but that's not for everyone. I think for the management piece of it, it's just how long you want to hold on to it. Like I was sort of on the fence about selling this 4-unit, and it was starting to get annoying, and so I sold it because I knew I wouldn't hold on to it for 3 or 5 years, more than 3 or 4 years. On the other hand, right now it's awful, replumbing a 1910 building with fully occupied with all the people in it. It's awful. But I'm doing that because like this is a building I just want to own forever, you know, and so like I'll take the cash flow hit and come out of pocket to do that if I have to, because it's just an asset that I know I want to hold on to forever. So it's hard to do, but I think as you get more experience, like you know like the real gems you have. And for me, it's worth any sort of management headache to hold on to those gems. But if they're kind of on the fence, I'm going to sell them and look for a gem, kind of thing. Yeah, of course. Any other questions? Yeah.
And based out of state mostly, how are you finding your deals? Do you do MLS for the most part, or wholesale, or what's been successful for you in the last?
In my experience, there's like 2 or 3 agents in any city that I've gone to that like get real estate investing. And they are not just offering MLS, but they're kind of like going out and finding pocket listings and off-market deals and sort of make their whole business around working with folks like me and people who are investing out of state. And so I've had to interview a lot of agents, but I've found that in any of these markets, you can find these people. And typically that's what I'll do. I will say like the pocket listings aren't really any better than the MLS deals for the most part. So I think you could do it on market too. And I think in most markets in the US, that is one of the things in this great stall period. I do think like MLS deals are coming back, and maybe not in Seattle, but like a lot of parts of the country, you're going to be able to find deals on the MLS again as sort of the pendulum is swinging back in that direction. Yeah.
Yeah, following on that question, how do you, like, when you're talking to out-of-state agents, what do you ask them to assess whether they're a good agent for an investor and kind of are able to suss out those deals, and like, what do you use to assess an agent?
Yeah, it's a great question. I know people say, you know, see if they invest themselves. I think that's a good one to ask. I usually start with like a very open-ended question, and I like just say like, what's the move in this city? Like, I'll get on the phone and be like, I'm not capital constrained, and even if I am, I would say that. I would just say like, if you were me and you had no money, you had unlimited money, what would you do in this city? And see how articulately they can explain a strategy to you. Because if they go up and they're like, oh, there's, you know, you could buy this single family in this neighborhood, but don't really have any thought behind it, I'm like instantly out. If like I had a call with a guy in Chicago the other day because I'm thinking about buying there, and this guy just like pulled up Google Maps and walked me through like block by block, like this is what happened here, this is what happened here, and he was like showing me the convergence of different neighborhoods. Then the next day, he sent me 5 different deals that he liked with spreadsheets. I didn't ask for any of this. He just did it all on his own with spreadsheets already analyzed. I took his numbers, I analyzed, I'm crazy, but I put it in my own analysis and mine matched up. And I was like, all right, this guy's not bullshitting me. He's not like making up bad numbers. And now when he sends me them, I'll like take them a little bit more seriously. So like that's kind of the process I do. I actually don't even ask them that many questions. I kind of just like see how they operate and see. Maybe I get special treatment, but like they send me, you know, they send me the things I would expect. So I don't have to like ask a ton of questions, and I would encourage you to do the same thing. The other thing is like you can also ask for references, which I do think is really helpful out of state as well. So I would do that as well.
What's Chicago guy's name?
Dan Nelson, he's awesome. He was on the podcast a few times. You can listen to his episode. Yeah, he knows a lot of stuff. Yes.
Hey Dave, thanks for the great presentation.
Yeah, of course.
So it's probably a good idea to diversify in real estate, not just invest in one market, but maybe you don't want to invest in 20. So like there could be some markets that are performing great, so you want to invest more in those. So is there a certain number of markets you consider at a given time or over your portfolio overall?
Yeah, great question. Yeah, I love to like tinker, so like I'm always like looking at things. My wife's like, "Will you just buy one 50 unit and like call it a day?" One day. But no, I think that's right. I think so the investing out of state thing is like very much about the quality of the team. So I think like if you can find more good people, you could do it, but I just don't think you need to. I personally like only will go into a different market if it offers something I can't get somewhere else. So like I originally started in the Midwest because I was in Denver before it started performing terribly like it does now, because it was just too expensive and you couldn't get cash flow anymore. And I was like, all right, I'd still keep investing in Denver. The appreciation upside's great, but I want to move to the Midwest and like balance that out. And so I started looking at that. And now, honestly, I'm just looking in Chicago because I'm there a lot. I have family there. So like I kind of just for convenience sake looking for that. So it's just like, it's not like I can't get, I invest in Michigan. So like, it's not like I can't get the same deals in Michigan. But actually one thing is you can get in Chicago like more newer, better housing stock for multifamilies than in some of the places in Michigan. So like, that's how I think about it. It's really a question of how much time you want to spend on this. Like I personally believe you should probably go to each market you invest in maybe once a year, every other year. And so I'm trying to limit it to like 3 or 4 that I primarily invest in. I also invest in syndications, and I'll do that anywhere because I don't actually have to set up the operation. So like that's another way I diversify is by investing in other people's deals when they know those markets really well. I just think like I look at data all day, like you can't know that many markets really well. And so I think you're better off like erring on the side of fewer than more is probably the concise way to answer that question. Well, thank you all so much for being here. If you guys think of any questions, again, you can always find me on Instagram or on BiggerPockets. And hopefully I'll see you all again at another Seattle meetup. Thanks for having me.
Awesome, man.
Yeah.
That's great.
Thank